I'd like to thank everybody in the room. We look forward to presenting our half-year results, our half-year numbers, which will be for December, and just sharing some of the initiatives that we as a business have undertaken in the last couple of months since listing. My term of life after listing, we actually have been living in it as we successfully listed on the London Stock Exchange on the 31st of July. So on behalf of Leon and I, I'd just like to welcome everybody and everybody that is viewing our podcast today. So if we could just get into the presentation itself. So as I've mentioned earlier, we successfully listed on the London Stock Exchange around about the 31st of July 2018. We raised $132 million around at that stage. And it was quite a large task for the business, as you can imagine, seeking a main board UK listing. And after the listing, we really have been focused on many of the initiatives that we mentioned as part of the listing process. So as a management team, taking transfer of the assets. So to date, we fully deployed the $132 million that we raised, being able to ensure the asset management of our existing portfolio. We spent a lot of time through the listing process putting in a full regulatory and compliance team into the business, which has really stood us in good stead for the main board listing. As you currently are aware, we currently sit with 3 listings, and most of them are, all 3 are main board listings. We sit with the JSE, the Mauritian Stock Exchange, and the London Stock Exchange. So really as a team, it's been ready to focus on the deployment of that capital, focus on really, as I've mentioned, some of the initiatives. So we really are quite excited with the numbers for 6 months, knowing that the 12-month numbers that we will be bringing forward in June are very much on track to what we said we were going to deliver. So from a distribution perspective, we are still on track to distributing 3 to 5% annual growth, which will be for the June results. The other key aspects is that as a management team, not only are we focusing on the distribution side of the business, but we're also focusing on the net asset value side. So you will see through the presentation some NAV initiatives that are able to increase the NAV and the NAV positioning of the business. And those NAV initiatives are really around asset management, really around the actual structure we've put together around sweating the current portfolio itself. So for us, the investment strategy, if you remember from day one for Grit, was really to focus on multi-geography. Today we have investment, and Leon, if you can go to the next slide, into 7 African countries. Multi-asset class, which is key. Multi-asset class really being derived around the fact that there are asset classes that are going through more challenging times across the continent and across the world, and I'll go into retail specifically. So multi-asset class, multi-geography, and today close on 95% of our revenue streams are collected in hard currency, therefore mitigating the local currency exposure. And that is absolutely critical to the nature of our business and what we do. And those 3 really key investment strategies are something that we will into the future really not compromise on. So the multinational tenants, so you'll see from this particular slide, we have close on 93% of our tenants are let to multinational global guys. And I think we've put Mozambique, Leon, as a case study here. Mozambique is a great example of what that actually means. So we've owned our portfolio for 4 years in Mozambique through what I call macro hell. Mozambique has had significant political issues, challenges, as we all know, but our portfolio there has been completely resilient to the macros. Yes, it's been challenging. Yes, it's become more complex. Yes, the central bank has become more complex, but the actual tenants that we sit in our buildings, the American embassies, the Anadarkos, the Barleys, the Bollorés, have conducted business as usual. And what we've seen sort of progress in the Mozambican market is we've seen that from it really going through some macro challenges, in the last 12 months, we have seen a significant uplift in that particular market, being the fact that we have almost fully occupied all of our assets in Mozambique. We have had Exxon approach us for additional space and additional residential units in the market, which is really exciting. Exxon are deploying a whole lot more staff into Mozambique around some of their contracts that have been signed. So for us, that multinational approach is absolutely critical across the portfolio. Interesting enough, you'll see a slide that I'll show you just now that shows you that 15 tenants make up close on 65% of our revenue stream. And those 15 tenants are really what we focus on from a multinational, multi-global, A-grade perspective. So really just focusing on what we call achievements. I think this previous page was called highlights, but achievements sounds so much better. But Leon will really be going into the financial highlights, and I'm not going to go too much into those. But really as a group, we've seen significant growth over the last 4 years, and often been criticized for that growth, understanding is business still operating. And I think from the asset management initiatives and the growth in our revenue streams, the ability that our operating costs have been able to come down, which has just shown the ability to take advantage of our size and our presence across these African countries. We've built significant infrastructure into these countries. We have people sitting there, we have infrastructure, we have teams, which means that we can leverage off of that IP and that base for phase 2 of our lives. So you'll see that one of the things that we looked at is really around the cost ratio of the business. You know, the cost ratio of the business is set around over 1.4%. The ability to bring that cost ratio down of the business and that ability to sweat the current infrastructure costs. The other aspect that we've obviously very much significantly worked on are our lease renewals. You'll see that we've highlighted some significant lease renewals. We not only have existing tenanted building, but we have the capability of renewing those leases and still see rental uptick and still securing that hard currency lease. So we've seen mostly valuation uplift on our portfolio. Retail for us has been a lot more tricky. I think our strategy of convenience retail has been ideal for what we've seen from a macro retail perspective, but I think retail will continuously into the future be quite challenging. We've seen some of the major retailers out of South Africa struggling. The Edcon news is not, hopefully a lot of you are obviously aware of what's going on with Edcon, one of the large fashion retailers out of South Africa. You'll see that we have just over 1.5% exposure to the Edcon group. But what we're doing is we're looking at the retail strategy and we're saying our entire retail focus is convenience. It's mass market shopping. It's not luxury. It's been able to bring product back to people. So our shopping centers on the northern part of Zambia, Kitwe and Ndola, is servicing mass market. So you have a ShopRite that's servicing 4.5 million people. That is not the retail that is currently struggling at the moment. The retail market, the super regional, the luxury brands, the clothing retailers, that is the retail that's currently struggling. So if you go, really one of the big aspects of our listing in the UK, as you know, we've had a listing both in South Africa and Mauritius, and have really progressively built up the shareholder base. One of the rationales for going to the UK was really around diversification of the share register. Being able to bring a new institutional UK money into an African real estate story. Interestingly enough, the current register that sits 15% in the UK today is not necessarily your traditional emerging market, frontier market money, which is quite unusual because we are an Africa story. The fact of the matter, because of the consistency in the delivery of our distribution, how many distributions we've made to date, because of the growth in our distribution, we are seen very much as a strong income fund to some of these big institutional UK guys. So you had UK institutional investors invest in group that had never invested in Africa before, because they were looking for alternative investment, because they are not seeing dividend and they're not seeing growth out of the European and UK markets. So the benefit of having those UK institutional guys in our register today is the ability to grow those guys over time. And for us, things like liquidity, being able to make sure that it's fungible between the 3 exchanges, being able to ensure that we track close to some of the major indexes is absolutely critical, getting those guys on board into the stock going forward. We're very cognizant of the fact that one of our biggest shareholders, PRC, has had some unfortunate press. And one of the things that we're obviously working with is to just ensure that we make sure that obviously the governance side for us is critical. The whole UK listing, and you would have seen, possibly not through this announcement, but through the announcement that was put out earlier, Grit is seeking a premium listing. So we currently house and have a standard listing in the UK, which is a main board listing, but we are now seeking a premium listing. Premium listing is the top listing in the UK. And what it means is that we are able to gain access into the main FTSE 250 index, which is really important for our business, from a liquidity, from the ability to attract new capital into the business. However, what comes with the premium listing is very stringent governance processes, very stringent governance scrutiny into our business, as with a standard listing, but it's obviously amount of work increases in relation to that. So the bulking up of our compliance team, the bulking up of our regulatory internal team is absolutely key. So the premium listing is something that Grit is seeking, and something that we should have success with this year already in 2019. And part of this premium listing, and as the slide depicts, we have a close monitoring on some of these major indexes. So we are a firm constituent of the SEM 10. I suppose that's why we're standing in Mauritius today. We are tracking very closely to the SAPI index in South Africa, which is the main real estate index in South Africa. We're tracking around 18th there. We'll hopefully close around 17. And then now it's to really gain access and the ability to go into the main FTSE into the UK. So really around the corporate action of the business, around what we're seeking on the premium, I think what's important is that at the end of the day, we are a real estate portfolio, a real estate company, and we are a real estate management team. So the ability to asset manage and run assets across Africa for us is really what our success has been. So one of the sort of strategies on the multi-geography was the diversification, which saw entry into Ghana as part of our capital raise. Ghana, we acquired 2 office buildings. One is tenanted to Tullow Oil, again, the multinational guys. The asset that we acquired in Mozambique, even though we are cognizant of our Mozambique exposure, so we have a soft hurdle as an investment committee. We don't want to be more than 25% exposed to one geography as the portfolio grows in size and stabilizes. But the Mozambican asset we bought it currently houses the American Embassy, the US Embassy, and Anadarko's corporate accommodation. On day one, we saw valuation uptick from this particular asset, which assisted us with regards to the cost of what the LSE listing and the process and the NAV dilution we saw. So the benefit of bringing on yield-enhancing, NAV-accretive assets for us is key. So the American Embassy building, if you understand the structure, the US Embassy actually signs that lease out of the US. In a lot of our instances, the actual international company, whether it's Imperial in Kenya, Imperial South Africa, guarantors the lease. That obviously assists with detracting from the perceived country risk that sits in some of these countries. So as we sit today, you'll see that the portfolio has really changed. Our retail exposure post the capital raise and deployment has come down and will continue to come down, and that really is a strategic approach. Not only is retail struggling at the moment, it's really around the management intensity that takes to manage a retail asset. So we're finding that the sale and leaseback, triple net lease, the sort of office industrial sector is a much more interesting asset class for us. As we've seen and continue to see, a lot of these multi-global guys have owned their own real estate across Africa because they've had to. Grit now, with our 7 countries, gives them ability to have a landlord that is able to service various jurisdictions. So we've seen growth in the various portfolios. We've seen rental growth. The retail, we are, Debbie and Heidi and their team are consistently focusing on the renewals of the leases, getting that WALE up from 3.2, which retail traditionally sits at lower than the balance of the portfolio. The occupancy for us is key, and if you take out what we're doing on ANFA and the redevelopment of ANFA, which will be completed mid-year 2019, we will then sit post-ANFA at an occupancy of 98.5%. That is quite significant for a portfolio of our nature. If you benchmark that to any MSCI stats or IPD stats, we are sitting at a mostly occupied portfolio. So in this market where other portfolios are under distress in other markets, Grit sits at an almost occupied portfolio. The cost to income ratio is something that we obviously manage as a business. We have got a really aggressive drive at the moment to internalize all of our property management, to really take the benefit of having so many assets across these jurisdictions and sweating that particular cost base. The retail devaluation that you see today is driven particularly by the Mortet asset and Zimpeto. And what that is that it's assigning tenants now at slightly lower rentals. We believe as a management team we've seen the pain and we've taken the pain through this valuation process now. We actually see a potential uplift on these assets going forward. You'll see some of our NAV initiatives on some of our smaller shopping centres is our redevelopment initiatives that we're taking in those assets, signing longer-term retail leases. So those will all see a positive uplift. But you'll see the office and hospitality has seen a positive uplift on the valuation. On the corporate accommodation, so you know, just to clarify and again to reiterate, we don't take residential risk, but we will do corporate accommodation. So corporate accommodation has really been able to service the underlying tenant, the international global guy that needs a residential solution, really governed by the same lease. The corporate accommodation, we've seen an increase in this and even an increase into our pipeline. The light industrial side, again, is also something that is a big focus for us, especially through our East African hub. So we're seeing a lot of big global groups looking at the potential to put their money back into their operations. So it gives us a benefit of being able to secure those assets going forward. So again, what this slide really depicts is really what I mentioned from at the beginning, is that we really focus on multi-geography and multi-asset class. And interesting enough, I remember putting this business together 6 years ago, being quite criticized for that because I come out of a market where guys are now becoming specialists. And I think I was quite emphatic around, we had seen so many real estate companies leave South Africa and being over-saturated to one market, or being commodity driven, or a particular cycle driven. We are not driven by those aspects. So if you look at our tenant base, they're driven by many different sectors, whether it's hospitality, financial services, partly commodity. There's all sorts of drivers that drive our particular tenant base. So the multi-geography for us is key. You know, we've all seen too well what's happened in some of these markets across Africa. So for us to have that soft hurdle that we don't want to be more than 25% exposed into each geography is key. We do see more sophisticated capital markets in some of these markets. We see further expansion into Kenya, the ability to launch a REIT into Kenya. We see further expansion, which is very, very small at the moment there in Botswana. The ability to create more of a corporatized structure in Botswana. Again, we want half of the portfolio exposed to investment grade Africa. And I always have to remind people there's such a thing as investment grade Africa, and that's countries Mauritius, Morocco, Botswana. Those are not necessarily going to shoot the lights out from a GDP growth perspective, but what they are stable. The ease of doing business, the ease of getting debt, the ease of moving money, the ease of actually trading in those markets. So that's really where the sort of structure of the portfolio from a geographic perspective. And then the multi-asset class. So the multi-asset class, as I mentioned earlier, you'll see retail diminishing, you'll see light industrial, you'll see corporate accommodation, you'll see office expanding. And again, focused on those global guys. So I'm not going to go too much into this slide, and I think there's 2 slides, one by sector and one by country. But really just to give you an indication is that Grit today sits with 25 assets. Sort of the per property value itself sits just over $735 million. The key aspects are what we focus on as a management team. We sit with a WALE of just under 7 years. So the letting initiatives, most of the letting is done by the internal team. We house those tenant relationships, and we hopefully will expand that going forward. Again, something that I used to really address up front in our presentations are these average rental rates per square meter. Again, Mozambique is a great case study. So Mozambique, when we acquired the portfolio, sat at an average rental of around $24 a square meter. New builds came into the market that were marketing at around $40 a square meter, and then macro hell of Mozambique happened. And what we've seen is we've seen a pullback, but we haven't seen a pullback on our own portfolio. So markets, you know, I think I've settled around $32 a square meter in Mozambique, but we haven't seen any rental revisions or retractions on our particular leases. So you have to be so careful of this when acquiring assets. In Nigeria specifically, there was an asset that was marketed that a tenant had signed at $90 a square meter when Nigeria was booming. Nigeria obviously went through its macro challenges, and tenants are going into that same asset today at $45 a square meter. So you have to be so careful where in the cycle you are acquiring these particular assets. So some of the more material sort of lease extensions, which is quite important. So as I've mentioned, our team we've got a very much internalized letting and property management team. And some of the sort of larger extensions that we've done of the leases, we've done a lot in Mozambique around our particular assets. I think as we sit today, we've got a mostly occupied portfolio in Mozambique. We've got a lot of work that we're doing with Exxon, which we're really excited about at the moment. The Moroccan asset in itself, as you know, is under redevelopment, ANFA. Heidi and her team have been very successful in extending some of the bigger retailers like Marks and Spencer. I think yesterday I was told it's actually a 15-year lease now, which is quite exciting. So again, those are great evaluation uplifts for our business. So if you remember through the LSE process, we lost quite a bit of NAV valuation on Anfa because it was under redevelopment. We lost approximately 7 cents. I think for us as a management team, there's a big push to get that back into the business and get that revaluation done. So the development is very much underway, and the centre's trading and currently operating. So for us, we're really excited around that redevelopment. I mentioned earlier about 15 of our tenants. You'll see some of the bigger brands, and some of them you'll recognize being Mauritian brands, being Beachcomb and Lux. You'll see some of them we're not meant to name, and Debbie will probably moan at me, but the guys there are Anadarko, some of the global oil guys, Tullow, etc., etc. So again, it's to take this list, and then you'll see the Edcon exposure. I think Edcon, guys that understand the South African market, is quite hot in the press at the moment. I've actually just been advised that I think Edcon's coming out with another announcement today. We're not too concerned, one being that the brand that sits mostly in our Edcon exposure is actually Jet, which is more their discount brand. So we think that there will always be a home for Jet in whoever buys them out, whatever happens down the line. So we are not as heavily exposed to the Edcon brand, thankfully. But that's really, and you'll see these guys, if you look at the industries, again, driven by different industries, which is so we're not purely commodity or purely financial services driven. So just some of the asset management initiatives. So I think one of the key things is, yes, just distribution is great, and growing that distribution 3 to 5% annually. I think some of the asset management initiatives is really to now focus on the NAV growth. How do we take the current NAV positioning and how do we grow that NAV? And really that becomes in sweating our current assets of redevelopment. So Anfa I've mentioned extensively. Buffalo is more as an asset we're looking at disposing. We've received a great offer. It's not strategic to our portfolio. We're doing a redevelopment at Zampeto Mall. They've been able to add on additional GLA, as well as we've just put in a new anchor there, being Spa. Mordetet, we've also done a whole lot of tenancy initiations around that. VDE, which is really exciting for us, houses Vale. In Mozambique, we've been approached for a redevelopment of VDE and an expansion of that. So again, that is housed in our current portfolio. Imperial is an asset we own in Kenya. We did a sale and leaseback with Imperial. Part of the acquisition, we actually acquired the land. So we're developing out of phase 2 for that. Boloree, there's a potential redevelopment. And we've got other assets, as you can see here, where we see that potential NAV uplift. So interestingly enough, coming out of the SA REIT market, which is so distribution driven, coming through to the UK market actually focuses a lot more on NAV. So we've had to really look at the strategy internally and say, okay, distribution, 8.5% dollars, fantastic, 3.5% growth, but how do we really get that NAV growth? How do we sweat and grow the NAV within the business? So I think on the Mozambique case study, I think it just gives you an indication, what I've mentioned earlier, around what's happening in the local office sector, around what we've seen as a portfolio over the last 4 years, versus what the office sector's actually performed at. I actually don't think I missed that stat, it's 33.8% vacant, which is quite scary. But I think the reality is that if you go to Mozambique and Maputo today, and hopefully some of you have gone there, Grit owns most of the A-grade type buildings in that area. So the vacancies are really being pulled out of some of the lower grade assets that haven't really been redeveloped over the years. So you'll see our occupancy, our vacancy is 0.3. We should have put 0, I think. But it's really, really minimal. We've seen growth in the office portfolio. The rental rates that we've been able to achieve. So again, Mozambique for us really demonstrates the investment strategy, and that if we stick to the investment strategy, how it optimally can work for the portfolio. Talking about pipeline, and I'm always nervous talking about pipeline because the fact of, Grit's not here to grow for the sake of growing. I think what's very important is that, yes, we have opportunity, yes, we have first mover advantage, yes, we have IP and people on the ground in these markets, but we turn away a lot of opportunities too. So we see a lot in the market because of our capital platform we have today. We have turned a lot away and continue to do so. But really our strategy is going to be focused, as I've mentioned, those are the countries that you're going to see growth in. And the asset classes that you're going to be seeing driven out of those markets are really going to be the sale and leaseback type opportunities. through the premium listing, through the possible inclusion into the FTSE, we have really some significant pipeline and really some exciting growth. It's very important that the asset management continues and the strength of the asset management team of the existing portfolio continues. But to be able to leverage what we've created over the last 4 years is quite key. And Leon, I leave the rest to you. Thank you.
Hi, everyone. It's a pleasure for me to actually present these numbers. Again, it's been a solid 6 months performance, some very key highlights. I think for us, the biggest thing is our income producing assets in line with the London listing increased by 20%, up to nearly $800 million, which is great. In terms of just the balance sheet as well, our loan to value sits at a much healthier 43.4% versus 51% where we ended the year. I think the London listing for us was quite a crucial thing, not only to restructure the balance sheet in terms of the risk, but also to create an environment where we had a much more diverse portfolio, the entrance going into the Ghanaian market, and the future potential that we're seeing from that. We did make quite a big investment in the actual listing, but we're starting to see those fruits coming through now. The one thing we needed to make sure, obviously, was that with the capital raise, we didn't want to dilute any earnings of the current shareholders. There was a few impacts, specifically in the retail market, which did hurt our numbers slightly. We also had a slightly negative impact on the euro's movement to the US dollar. If we look at December a year ago, we were basically sitting at a 124 to the dollar. Today we're sitting at 114. So that's come through the numbers. It's not as significant as one would think, because we do hedge out a lot of that position just through the use of gearing. But there is an impact on our numbers that does come through here. So we're seeing our total distributable income for this 6 month period, bearing in mind that we added nearly 100 million shares, is coming at 6.06 cents per share. Comparative period was 6.07 cents. So it's considerably flat. I think the impact of the euro did hurt that number slightly, as well as the other items that I just mentioned. I think it's important to note that the current portfolio performance and the fact that the assets that we just brought on have come on in the last sort of quarter of this year. So we are in a strong position to be able to make our full year targets of 3 to 5% growth. That should come through strongly in the next 6 months. I think one thing we need to understand is what's happened to the NAV of this business. With us now being listed in London, with us now having a renewed focus on really the actual NAV of the business and not being overly focused on distribution, we need to really try and unwrap what's happening with the NAV of this business. We did make a significant investment into the corporate structure this last 6 months with the London listing. It was a costly exercise, but at the end of the day, it's given us probably the best platform for growth in terms of African real estate. Not only have we now got the complete corporate governance stamp from the requirements that we need to live up to in the UK, but it also has created and unlocked a lot more opportunities for us in terms of pipeline, in terms of sale and leaseback opportunities, but also in the capital markets, in the ability to raise debt from different sources, and has provided us with the ability to really take this platform and take it to new heights. What we're really excited about is just the current portfolio's actual performance. We try to strip this out just to show what the real impact of the current portfolio, what it's doing. So we've seen 5.15% growth in NAV just from the current portfolio. That's stripping out any impact of acquisitions that we've had and obviously the cost of the capital raise. That investment, I think, is going to stand us in very good stead going into the future. Just in terms of debt, which is obviously one of the key components of our capital structure, we rely quite heavily on a multitude of banks. We've got very good relationships with banks and continue to develop those with new banking relationships. The one that you'll see there is Barclays. They've been the primary funder for our Ghanaian portfolio, and we see a lot more ability to grow with them as time goes by in new jurisdictions, as well as on the current portfolio. But for us, if we're looking at that graph there, you'll see there's quite a bit of debt that comes up sort of between now and 2020. The bulk of that is actually in the process of being refinanced with Standard Bank. The vast majority of that is actually our initial loans that we had for the assets in Mozambique. So we are currently doing a portfolio refi on the entire Mozambique portfolio. This does bring us quite a nice saving by combining all of that debt in a syndicated loan structure, which should see our cost of funding from that portfolio of debt coming down by around about 1%. That equates to roughly $2 million a year in interest saving. The fact that we are now very much multi-banked Standard Bank has just recently overtaken Bank of China now to be our biggest funder. We will see quite a lot of movement in this going into the future, and as we bring new banks into the pool, and with the growth of Barclays. The one thing that we are concentrating on is obviously we have this euro exposure in our portfolio. When we look at currency risk, the biggest currency risk we face is the euro versus the dollar exposure. In the point of income, it's not that much in terms of the impact that it can have on us in a financial year. But any balance sheet revaluations that we need to do as a result of movements in the euro needs to be hedged out, either through natural hedges, increasing gearing on the euro portfolio, and then bring down the gearing on the US portfolio. These are targets that we've set ourselves for this next 6 months period, and we're going to be focusing on that to not only then have the balance sheet hedge that comes in place, but the added benefit of a reduced cost of funding in terms of more euro debt. In terms of the income statement, when you look at the comparative numbers, there's some very strong growth in the numbers. If you look at our revenue line item, 25% to 26% increase there. In our profit from operations, that's up significantly, 75%. Just in terms of some of the ratios that we monitor closely, our cost to income ratio in terms of the operating costs of the malls and the other assets, we've gone down from 18.6% to about 15.2%. I think some of the initiatives that we've put in place in the last 6 months to 12 months is now starting to come to fruition. Predominantly, there's the internalization of our property management, specifically in the Mozambique area. That's all now internalized and run by Grid itself. We're seeing very good cost savings come through there, but we're also then having the added benefit of us really owning that relationship with the tenant without having a third-party supplier being involved in that process. As Bronwyn's alluded to many times, the strength of the counterparty is the strength of Grid, and not having that ability to really own that relationship with the tenants does create a risk factor that we want to eliminate completely. Just in terms of the balance sheet, just to highlight there again, a fairly significant increase in our income-producing assets. The one item that you will see here is the reduction in our investment in associates. It's just one of the assets that we've now increasing our stake in, and now it becomes a consolidated asset versus an asset that's dealt with as income from associate. But it also includes the upside now of the growth that we've had in the portfolio with the acquisition of Fifth Avenue, with the acquisition of the CADS building, which is the Tullow head office, as well as the Acacia residency, which is the American compound for the embassy staff.
Thanks, Leon. So just to conclude, thanks. If you can just go to just to conclude really around the outlook and what's next. And for us, really, it's focusing on some really key aspects of the business. So really making sure that we can deliver the distribution targets that we've put out to the market around 3 to 5%. You would have heard us say that many times. The minimum total return, which means the NAV growth needs to be seen of around 12%. The ability to really look at the funding side of the business. Leon mentioned the Mozambican initiative now to reduce the overall cost of funding. As we do have a geared portfolio, the cost of funding is quite important in the business. The ability to look at the debt levels, we had committed to sit around 35 to 40%, and we're very much on target on that for the June financial year. Really focusing on the footprint of our existing geographies and working with those global guys to be able to understand their real estate needs, to be able to become their real estate partners. So to be able to say that we've built up this IP, we've built up this business, we've built up the team, got over 70 people located in these countries, excluding our partners, and being able to leverage off that to really grow this portfolio going forward, off the multi-geography, multi-tenanted, being able to have the asset class diversification, and the strength of the underlying tenant is going to be really, really critical to the pipeline going forward. So on behalf of Leon and I and the rest of the management team who's here today, I'd really like to thank you for coming through and also listening to the results. We look forward into the future. We've got a lot of initiatives. We look forward to the growth, to the premium listing and being able to embark on that process going forward, and to the support of the people that have worked with us extensively, our financial institutions, our investors. We really look forward to taking this business to the next level. And as you know, we're definitely a dynamic team, so there's nobody asleep here. So we're looking forward to the next chapter. Thank you. It's in the intention to actually take questions now. Hopefully the presentation's been so thorough there'll be no questions, but you're very welcome to ask questions. We'll also be available for the people that are here afterwards, and a lot of my team are running around. I should have dressed them in bright red so that you knew who they were. But if we can take questions, that'll be fantastic.
Question for Leon. You talked about the distributable income at 6.04. The actual payment was this. Can you just expand on that?
Yes, I think with all the NAV initiatives that we do have, which Bronwyn highlighted in the slide, there is a requirement that we have a slightly bit of a war chest that we've got available to us to ensure that the success of these programs comes through. It's crucial that we get the ANFA project, for example. If there's any unforeseen costs that pop up there, we want to make sure that's done. We want to be able to capitalize on the costs that we're going to incur in terms of the development of Imperial Phase 2. We want to start investigating things like the Bolloré warehouse. That site is in the perfect location in Pemba. Now's the time to really start the groundwork on that. But the ability for us to now distribute that at year end will be there. We just want to make sure that there's going to be absolute intention now to fulfill those goals and make sure there's nothing that's going to impede that.
Questions? Any more? Good? Are we good? Good? Thank you, everybody. As I mentioned, we will be available to chat afterwards, so you're very welcome. And there's coffee, apparently, so fabulous. Thank you. Thanks, everybody. Thanks for your time.
Already asked that question.